Hey guys, what's going on? Welcome to the video. So in this video, I'm going to be talking about a couple of stocks I'm down a ton in, what's my plan moving forward, and also some pros and cons of taking a loss in the stock market and on an investment. What does that help with tax-wise, and how can you use that to your advantage? And also going to be going through my plan moving forward with these stocks that I'm down a ton on. Alright, so let's go ahead and get into the video. Alright, so the two stocks I'm down a ton on, close to 50% down, is XL Fleet, ticker symbol XL, and Romeo Power, ticker symbol RMO. I was buying XL Fleet. First off, I was buying at $20 with a tight stop loss. I got stopped out as a trade, and then I got into XL Fleet as an investment because I like the valuation, I like the future growth potential, and I like the chart. So I got into that investment at $14 per share, and now the stock is right around $8 per share. So down big on that one, close to 50%. And then also Romeo Power, ticker symbol RMO. This is one that I started buying in the $18 range as an investment, not just a short-term trade. And then it got heavily beat down. I averaged down towards that $12 level looking for a bounce and never really did bounce, just got some consolidation. And now, just like XL Fleet, is down in the $8 range. So down very big on both of these, close to 50%. So before we get into why these stocks are dropping and my plan moving forward with these, let's talk about taking a loss in the stock market. So realizing a loss and taking your loss by selling out of your losing position on a stock, this can help you offset taxes for other capital gains. So let's say, for example, you're up $100,000 in stocks this year, but you're down $10,000 on one of these stocks. Let's say you're down $10,000 on XL Fleet because of the huge dip. Now, if you sold XL Fleet, took the loss, this would offset your capital gains tax. So instead of paying taxes on $100,000 worth of capital gains, you're now paying taxes on just $90,000 worth of capital gains because you took that $10,000 on XL Fleet, and you can do this for any amount of your capital gains. Now, another example, so that's where that example can help, but get into another example. Let's say you're not up in stocks at all this year. Let's say you're only down $10,000 in stocks, and you're starting to realize those losses and taking your losses. So what you can do with this is up to $3,000 per year. You can write this off against your income and not pay taxes on that amount. So let's say you take that $10,000 loss, you're down overall in the stock market this year. You can use that to offset your personal income. So instead of paying your full salary income, you can deduct $3,000 worth of taxes. So if you made $60,000 at your job this year, you're only paying taxes on $57,000 because you took that $10,000 loss in the stock market. The next year, the same thing. You can roll that the rest of that $7,000 over until you use that whole $10,000 of writing that off against your income. So you can write that off $3,000 one year, $3,000 next year, $3,000 next year after that, and then $1,000 the final year. So that $10,000 is gone. And also at the same time, if you're down $10,000, write off $3,000 that first year. The second year, let's say you're up $10,000 in the stock market, you write off the remaining $7,000. So now you're only paying taxes on $3,000 worth. So that's where offsetting your gains comes in for taking that realized loss and how it can help with taxes. So taking a loss is not all bad. You can get a lot back from taxes. So if you're no longer bullish on a stock, maybe your thesis has changed, maybe it's not a bad decision to take that capital loss, realize that loss, so you can write that off against your capital gains tax or your personal income tax. Alright, so now let's get into XL Fleet, Romeo Power, and what my plan is moving forward and why they took these big dips. So this stock is down massively from highs at $30 plus and now sitting right at about $8 per share. So the big dip recently happened from Romeo's earnings. So the results were that they lost $19 million in quarter four. The per share loss was 24 cents compared to 18 cents a year earlier, and the revenue rose 48% year over year. And the forward guidance that this company gave was that Romeo Power expects to see a 2021 revenue of $18 million to $40 million in between that range. So the reason that management states that they missed their earnings was that they were constrained and in a shortage of a supply of battery cells. They expect that the shortage will result in Romeo Power's full year 2021 revenues being materially lower than originally projected. So lowering their guidance and stating that they do not expect to reach these next year expectations, this is the worst part because the stock market trades on future potential and future expectations, not just past history, and especially with these beginning stage growth stocks, when they lower their estimates for the future, this absolutely kills the stock price, which is what we're seeing right now. Now, the second thing that is killing this stock is in their investor presentation and with their expectations they've been saying this past year, management and IR has big projections for the future for this company. And right now it does look like they did overestimate their company and overvalue their company by a lot. They estimate that by 2022, they're going to have $412 million in revenue. Now, taking a look at these results that we just saw in 2021, they expect to see revenue totaling $18 million to $40 million. So just taking a look and comparing this to their estimated 2022, the maximum amount that they expect for 2021 is 40 million, and their 2022 revenue estimated is 412 million. It is very, very unlikely that we see a 10x in revenue in just 1 year from 2021 at 40 million going to over 410 million in 2022. That is very unlikely. So it does look like this management did overvalue their company. And reasons like this is why we're seeing everybody saying that we're in a SPAC bubble, that a lot of these companies are overvalued. So it is important to see the risk of that. And I'll be the first to say I did make a mistake trusting the management, trusting the projections, and not seeing the full downside potential if these were not met, because they are lofty expectations. And it's not looking like these expectations will be met. So taking a look at the presentation, it's easy to see why I thought the stock was so undervalued when I was buying it at $18 per share, because with that massive growth that they're projecting, of course that would make the stock very, very undervalued, but it is not looking like they are going to reach those expectations. So what am I doing moving forward? So as of right now, I'm still holding my full position. The reason because I like this company so much in the beginning, because of all the partnerships and customers that they have, such as BMW, Lion Electric, Workhorse, Oshkosh, and a bunch more. So that is where my main thesis is built around, their customer base and their future sales. So right now I'm still holding full for that reason, but if there was any news coming out, they're no longer partner with some of these companies, that is when I would look to exit my position and take the loss overall. But if they do keep these customers, I do think the growth potential is still going to be there, even if management did overvalue the company at the time, valuing the company right at about $1 billion in market cap, which is a pretty fair value for what expectations should be as of right now, what we know from their future projections after seeing this recent earnings. So I think more is now a fair valuation. We could see some more short-term selling in fear, but I do think it should find a base in this $8 to $10 range. And then from there, it is going to depend news-based and earnings-based in the future. But overall, I do think the EV battery sector is going to be massive in the future. And for that reason, I'm still in this stock. I see massive future potential in the space. The company is more fair valued at this price. So I am okay holding, but if anything changes with the customer base or partnerships, that's where I'm going to be looking to cut my loss, because if that happened, my thesis would change long term on this company. Okay, so now getting to XL Fleet, ticker symbol XL. So XL recently dipped on their earnings announcement, and taking a look at what they said in their earnings announcement, they generated a full year 2020 revenue of 20 million, an increase of 182% of 7.2 million in the prior year. And in the fourth quarter of 2020, they generated 10.9 million in revenue, which is up a ton from 0.3 million in the prior year's quarter. So overall, these results look good and are in line with the company's projections. But this is where the stock drop came in. So they stated that in the first quarter of 2021, they are expecting a pretty big drop in revenues to about flat over the prior year's quarter, and they're projecting revenues of just $1 million in the first quarter of 2021. And they're saying this mainly because of shortages such as chip shortages and OEMs. So this is what is scaring a bunch of investors away and making the stock drop this much. So overall, they did project that in 2021, they would have close to $100 million in revenue, and in 2022, they'd have close to $300 to $400 million worth of revenue. So management on this one did state that they expect the full year revenues to pick up after the first quarter of 2021 because of all those shortages. So they do expect it to be in line with expectations, but it is yet to be known. And overall, the most likely scenario is they don't hit those full year expectations, even if they do hit expectations in the next couple quarters. So with XL Fleet, these earnings did give more confidence for their past results, and if they can show performance improving the second and third quarters of this year, I do think we could see a massive bounce, as it still would be mostly in line with their expectations that they stated with the presentation. And if that does play out, that means that this stock is massively undervalued at this current price. So overall, this is a close watch for me to add more. Right now I am just in a small position, but this is one that I'm looking to add to at current price. As of right now, it's in this short-term downtrend, but when it does break this downtrend, I do think we could see a pretty nice breakout back up to that $10 range. A lot is going to depend on next quarter's earnings and how those are looking though. So this is a very close watch for me, and one that I am interested in adding. And with Romeo Power, I am interested in adding more at this price, but no time soon. I do need to see more trust and performance from the company and management itself, showing how they're going to get up to those future projections. So if you're in these stocks or some other stocks that are heavily beat down, the first thing you have to ask yourself, has your thesis changed? Are you still confident in the long-term growth of that company? If you're not, if your thesis has changed, maybe think about taking that realized loss, moving those funds elsewhere if you see a big opportunity somewhere else. maybe putting it that if you think your money is best used elsewhere. The second thing you can do is if you're so confident in the company, you can be averaging down, lowering your cost basis, buying at these current cheap prices. So it's up to you. There's no reason to bag hold the company that you're not confident in, or if you need the cash elsewhere. But at the same time, patience does pay in the stock market. If you are still confident in the stock that you're in, even if you're down a good amount, sometimes it's smart to be averaging down and buying at cheap prices if you're confident in the company. So I hope this video did bring some value to you. If you have not already, please like and subscribe if it did. I would greatly appreciate it and it helps me out a ton. And when you're investing in growth stocks and more beginning stage companies, these are always going to be very high risk, high reward, and that is my personal investing style. I like investing in these high risk, high reward growth companies because yeah, there's going to be some losers along the way, but overall, if you pick good stocks, a lot of these are going to be winners and pay off in the long run more than anything else. If you're interested in joining the private Discord chat, getting alerts every time I buy and sell, and also having full access to my personal portfolios, the link is down below. If you want to get some free stocks on Webull, get $30 for free on M1 Finance, or get up to $250 worth of free in Bitcoin and BlockFi, those links are down below. And hope you guys enjoyed the video. Let's get rich.